What is going on, family? What is going on? I hope everybody's having an amazing day. We are back with part 2. Okay, so title of today's video: liquidity. Okay, so today what we're going to be going over is just targets. Okay, just points of interest within the market. So some of the basic fundamentals that are just going to be able to help you off the rip. Okay, so liquidity is just area where there is money. Okay, so where is an area where there's money? Well, quite frankly, everywhere. Okay, so this is an example of just ideally what the markets would be looking like. So we can see that we have a little bit of sideways movement. What sideways movement is referred to as in the markets is consolidation. Okay, so consolidation is when we simply are just moving up and down, just moving sideways, not really getting any expansions either to the up or to the downside. So now that we understand that this is an area where we are consolidating, aka moving sideways. So we can see, as we talked about in the last video, retail, right? Retail patterns would cause people to see support and resistance. So in these particular areas, right, people are gonna be buying and selling, right? So right above where they're buying and selling, the reason why there's liquidity there, why there's money, is because people's stop losses are going to be right above and right below these areas of consolidation, because people are buying and people are selling. So what ends up happening here is we drive below, right, these equal lows that we have, right, and we capture liquidity. So all we're doing is hitting the stop loss of early buyers before then pushing the market back up. Right here down below, we can see that what we did was we actually were moving sideways, right? We were consolidating, and then we captured these highs. So once we captured these highs, right, you can see we actually proceeded to push lower. So what ended up happening, right, was we swept above, right, these highs. We captured this liquidity, and then we drove down. So essentially, areas of liquidity are just going to be areas where there's buying and selling offered, right? Another example of where a lot of liquidity would be, right? These right here are going to be some of the top, like most common patterns you're going to see, right? I'm going to show you on the charts afterwards, but here's another example of where liquidity would be. So pretend this is the body of a candle, right? So we can see this right here is essentially representing something like this. Okay, so you can see right here that we have this line. The lines represent a wick. Okay, the wick typically is going to have a lot of money, right? Why? Because the wicks, especially when we have long wicks, they're going to be areas in which, depending on that time frame, we weren't there for very long, right? And I want you guys to write this down. What's fast doesn't last. So in regards to the market movements, if you guys are seeing areas where there's a lot of wicks, typically there's going to be a lot of liquidity. So an example of how liquidity would typically, right, get filled is pretend, all right, we have a candle, right? This is another candle. So right below this wick, there's going to be money. Why? Because people have their stop losses here. So we have to understand that typically when we have these big wicks, right, we're going to push down and fill these wicks, right, capture liquidity before then pushing higher, right? And then the same on the flip, right? If we had a big wick towards the upside, we would fill that and then proceed to go down. So liquidity, like I said, is simply just going to be areas where there are money, areas in which people are buying and selling. So if we now go to the market, right, we can see a prime example of exactly what we just talked about. So if we go to the weekly, right, we see we have these two large wicks in here. So we can see that this wick and this even larger one, right, is exactly where we ended up coming down to. So what we ended up doing is we can see that the low of these wicks was right there. So what we ended up doing, right, to the most recent wick, right, anybody who really bought in this particular area, we actually drove slightly below it. So what we did was we captured liquidity, and then we immediately started to run. So what I want everybody to just kind of look at, right, is areas in which there's just very equal highs and equal lows. For example, right here we had equal lows. And what ended up happening here, right, we see this wick came and captured this liquidity, right? So in regards to that, even on the upside, right, we can see even in here we have equal highs, right, liquidity. This candle right here captures all of that liquidity. So realistically, what you want to do is just find areas where there's equal lows, equal highs, and then you want to just see what happens that last capture, that last sweep down, right? That last drive down before the up move, or that last up move before the down move. Okay? So in regards to this, family, this is going to wrap up episode 2, part 2, liquidity, right? Like I said, very basics. This right here, family, like I said, is going to be an essential to just helping you just find areas in which there's a lot of money and just potential entry points. Because once liquidity gets captured, typically you're going to be able to find entry points. But with that being said, family, I appreciate you guys, and I look forward to catching you in the next one.